Welcome to Growth Investing Mastery. This video will look at our November 2025 growth stock portfolio review. As a reminder, this is not investment advice or recommendations to buy any stocks. The purpose of this video is to review our growth stock portfolio. We have a disciplined and comprehensive strategy, which gets results. And our strategy is aiming to be in the best opportunities at all times. Our year-to-date returns are plus 104%, and since the start of 2024, we're up 402%. By the way, make sure you're subscribed to the channel with the notification bell. This way you'll get all our updates as soon as they're released. Jumping into our allocations, we have 3 high-confidence stocks. The first is AppLovin with symbol APP at 20.5%. Next, we have Astera Labs, ALAB at 19.8%, and then Iren with symbol IREN at 17.8%. We then have 2 medium confidence positions. The first is Electrovaya with symbol ELVA at 11.2%. The second is Hive Digital Technologies with symbol Hive at 9.6%. We then have a number of medium or low confidence positions. Reddit with symbol RDDT is 4.6%. DUOT Technologies with symbol DUOT is 4%. Dave Inc. with symbol Dave is 3.9%. Next up is BioHarvest Sciences with symbol BHST at 3.5%. We then have our low confidence positions, which also includes a few new companies. We have Paymentus with symbol Pay at 1.4%, SkyWater Technologies with symbol SKYT at 1.4%, and then another new company called FIGR Technologies with symbol FIGR at 1.3%. Next, we have Evaxion with symbol EVAX at 0.6%. Lastly, we have Organigram with symbol OGI at 0.6%. If you've been following the channel a while, we used to break out some of these smaller companies into something called microcap ventures. But we ended up selling a few of those companies, and some of those companies actually moved up in allocation as well. So we're not going to make that microcap venture distinction anymore. But just keep in mind that the newer a company is and the lower allocation a company is indicate we may follow that company a little bit less. Taking a look at our results, in 2024, we were up 146%. And our results so far for 2025 are up 104% year to date. The cumulative return since the start of 2024 is plus 402%. While the result of plus 104% year to date sounds really great, you can see on the graph how big our recent downswing was. Our high confidence positions had strong earnings reports, but the market sold them off anyways. And we did have a few smaller companies report poor earnings, which impacted our percentage return. It's helpful to get their perspective when you see the full 2 years. I wanted to add some commentary on the market and our results since we had a pretty big downswing. And growth stock downturns can happen suddenly and fast. These assets are often the first that get sold off in a more fearful environment. It's normal for us to feel fear in this situation as our portfolio underperforms the market. We use the fear as a signal, and it tells us to investigate further. So some questions we were asking were, are we in the best opportunities? Did each individual company we own deliver phenomenal quarterly results? And are we diversified enough? We started asking that last question about diversification when all our AI-related stocks were trading down in tandem. A few key takeaways from our strategy are: It's important to keep in mind that our strategy underperforms in tougher markets, but our strategy overperforms in flat markets and strongly overperforms in bull markets. Additionally, with the earnings season, we want to use disappointing earnings results as an opportunity. We get to reallocate to our other higher confidence positions, and thus we concentrate our allocations to those higher confidence positions once again. And lastly, we want to take care not to automatically equate lower stock prices with poor business momentum. For example, one of our top confidence positions, Astera Labs, had what we thought was a really strong report, but the stock price went down after that. So we want to make sure we don't confuse that lower stock price with the business momentum, which is actually picking up. Taking a look at our holdings, our largest position is AppLovin with symbol APP. Their product is ad tech that's expanding to e-commerce. On this latest quarter, the company had guided revenue from 1.32 billion to 1.34 billion, and they actually landed at 1.405 billion. Adjusted EBITDA was guided from 1.07 billion to 1.09, and that came in at 1.16 billion. So they beat their guidance by a reasonable amount on both revenue and profitability. But where this report really stood out is where they made their Q4 guidance. Revenue for Q4 was guided from 1.57 to 1.6 billion. And on profitability, adjusted EBITDA was guided from 1.29 billion to 1.32. We've owned this company for about a year and a half, and normally the company guides for the run rate of the current quarter. So this is a really big step up in revenue and profitability guidance. And that indicates the new product for web and e-commerce is gaining a lot of traction. And we're really looking forward to Q4 results, which was said to be a fun quarter previously. The holiday season should benefit the e-commerce platform. And something to keep in mind is the e-commerce platform is still having its growth restricted by using a referral basis only. Management wanted to make sure there's no bugs or no hand-holding needed for their customers. And so far, it seems like everything is on track. We thought this report was incredible, but the market did not appreciate the numbers. And the stock went down along with the rest of growth companies. But the price did recover a fair amount in the last week. Our next high confidence position is Astera Labs with symbol ALAB. Their product is AI Infrastructure 2.0. On the latest quarter for Q3, revenue was guided from 203 million to 210 million, and they landed at 231 million. GAAP EPS was guided from 23 cents to 24 cents, and that actually landed at 50 cents. Adjusted EPS was guided from 38 cents to 39 cents. That came in at 49 cents. So they beat all of their guidance by a significant margin. The new Q4 revenue guidance was from 245 million to 253 million, which would be up 79% year over year at the top end. One direct quote they had was they expect our overall silicon dollar content opportunity per AI accelerator to significantly increase. The Scorpio P series continued the volume ramp at the lead customer, and the Taurus product line drove strong growth with incremental opportunities. That's really good to see Taurus ramping up because previously Taurus didn't seem to be selling too well. Adjusted operating margin came out at 41.7%, a new record for the company. And something fascinating they mentioned on the call is that token generation is doubling every 2 months. That's just some commentary on the overall AI market, but it shows how fast AI is still growing despite a lot of doubts from the market. There were several new design wins at multiple hyperscalers for P series across a variety of platforms. The company is now gearing up for the Scorpio X series high volume production in 2026. One financial I noticed that really stood out is that sales and marketing is only 10 million of expense in the quarter. So the company doesn't need to do a lot of marketing to get their name out there. Industry insiders already know who they are. In this latest call, they were talking about multi-generational product lines. And they said we get invited to the conversation very early. Current designs are for products in 2027 and 2028. And they mentioned they can see the next 3 to 4 years of design wins in PCIe version 6. The company mentioned there'll be an inflection point in 2026 when Scorpio will be the top-selling product. That's really great to see that the company can mention they have this revenue visibility in the next year and future years to come. Astera Labs recently announced the Microsoft CXL ramp, or their Leo product line, and that scales up server memory by 1.5x. Overall, this was another strong report, but the market sold them off. Our third high confidence position is the company Iren, with the symbol IREN. Their product is a neo cloud with exceptional unit economics. The company announced a contract with Microsoft a few days before their earnings call. The total contract value was for $9.7 billion, and they got a prepayment of 20%, which is about $1.9 billion. What's remarkable there is that other neoclouds have not gotten this same prepayment offer. Iren is purchasing machines from Dell, and they'll be deployed throughout 2026 using 200 megawatts for this Microsoft contract. And keeping in mind the company has 2.9 gigawatts of contracted power, so you can see that this Microsoft contract doesn't take up much of their capacity. And Dell was giving a great deal to Iren as well. There's no payment for the machines until 30 days after they've shipped. The Microsoft contract will generate $1.94 billion of annual revenue, and the company expects their GPU fleet to scale from 23,000 machines today to 140,000 machines by the end of 2026. Vertical integration is a competitive advantage for Iren. They have greenfield sites and they're engineering their own high voltage infrastructure. The company controls the entire stack from the substation all the way down to the GPU. And the company said the return profile we're seeing in GPU as a service we think is incredibly attractive. Management pointed out they've never missed a construction or a commissioning date. And management also said they're confident they can deliver against the Microsoft timeline or even exceed it. Our next company is Electrovaya with symbol ELVA. Their product is next generation lithium-ion batteries for industrial customers. The company is reporting earnings on December 10th, and the revenue number was pre-reported as at least 20 million, or greater than 70% year-over-year growth. So we already know we're going to like this top-line number a lot. But we're looking to see how the profitability numbers land as well, which were not pre-reported. The company did an equity raise to further enhance their scaling efforts. And they mentioned 4 specific things that this capital raise will help. The money will be used for rapid charging enhancements, separator technology development, solid-state battery development, and their energy as a service program. The Jamestown, New York facility appears to be on track for April 2026, and that Jamestown facility has 3 times the capacity of their current facility near Toronto. The company was recently at the 17th Annual Southwest Ideas Conference. They mentioned there that 16 of the Fortune 100 companies are customers of Electrovaya. They have a lot of new product launches in robotics, airport ground transport, energy storage, and defense. Their batteries are currently being trialed at one of the biggest airline carriers. Management mentioned that the solid-state companies get good valuations. And you see these competitors are often worth 5 to 10 times as much as Electrovaya. From our perspective, the valuation for Electrovaya seems really attractive at about a 200 million market cap. Additionally, the company detailed partnerships with Toyota, who is white labeling the batteries. And there's the partnership with Sumitomo, a Japanese conglomerate. So we'll look forward to December 10th and see what Electrovaya reports then. Our next medium confidence position is Hive Digital Technologies with symbol HIVE. They are a Canadian Bitcoin miner with expanding high-performance compute sales. In the latest quarter, revenue was a record $87 million, which was up 285% year over year, and $82 million came from Bitcoin mining, while $5 million came from HPC. The company had $31.5 million of adjusted EBITDA in the quarter, and management said they're dedicated to having the best-in-class ROIC with disciplined capital allocation. One direct quote was, "We lead the sector in cash return on invested capital." The company has the lowest G&A in the industry, and they also have the longest standing C-suite in the Bitcoin mining industry. There's an additional 100 megawatts capacity coming online in Paraguay soon for Bitcoin. Their global electricity capacity is 540 megawatts, which is really impressive for a company with a market cap of about 800 million. Management also mentioned that Brazil may be an option for hydroelectric. They share a river with Paraguay, and there's early talks in Brazil. The company expects to get up to 35 exahash of Bitcoin mining capacity soon. Additionally, there's 6,000 Blackwells coming online soon to supplement their older 5,000 machines of NVIDIA Hoppers and A100s. They'll be deploying those Blackwells in 3 tranches. The first is with Bell Canada in Manitoba. The next is Sweden, followed by Toronto. And Bell Telecom is the largest in Canada. That's combined with their sovereign AI strategy. The Sweden and Toronto facilities are Tier 3 data centers, and they can support liquid cooling. The company has an end goal in 2026 of getting to 750 million of ARR. They also mentioned on this latest call there's over 10,000 unique users on their HPC platform called Buzz. I was really surprised to hear they have this many unique users. It seems like they may be appealing to smaller shops and getting smaller customers on board first. Management pointed out if they're valued like competitors, they would be a $20 stock. And that's a big part why we're invested here. This company has more mining capacity than Cypher or Wolf. Yet those companies are valued at over $5 billion, while Hive is valued at less than $1 billion. Our overall takeaway is this was a strong report, and the company still seems undervalued. The next company we own is Reddit with symbol RDDT. Their product is a community-based ad tech platform for social media. Q3 revenue was guided for 535 to 545 million, and they landed at 585 million. Adjusted EBITDA was guided from 185 to 195 million, which came in at 236 million. So there was a pretty impressive beat on revenue and profitability. The new guidance for Q4 was 655 million to 665 million, which would be up 55% at the top end. Adjusted EBITDA for Q4 was guided from 275 million to 285 million. And keeping in mind, Q4 is the strongest season of their ad sales. The trend for GAAP net income is really impressive for Reddit. Over the past year, it went from 30 million to 71, down to 26, but then back up to 89, and in the latest quarter, it was 163, a new record. Average revenue per user was $5.04, and management said this is still low on an absolute basis and remains an opportunity. They also mentioned their ad load is much less than peers like Instagram or Facebook. There's growing adoption of measurement tools, Conversion API, and their auto bidding program got released. One concern I have is that logged in users only grew 14% year over year, while logged out users grew 24% year over year. And US daily active uniques grew 7% year over year, while international daily average uniques grew 31% year over year. So you can see that international is growing faster than US. But the users in the US are worth a lot more because they have a higher cost per click. But I'm still okay with these user numbers because, as Reddit points out, their users get more valuable over time on the platform. They mention their most monetized users are the ones that have been on the platform for a while. That's in contrast to other social media, where users who've been on there for a while tend to drop off. So when Reddit acquires a user, they tend to stick around and they become more valuable over time. The management team also mentioned that Reddit is the number 3 visited site in the US. Overall, I found this to be a strong report, but I'm cautious on the user growth numbers. The next company we own is DUOT Technologies with symbol DUOT. Their product is edge data centers that are built in a shipping container. Q3 revenue was $6.9 million, which was up 112% year over year. They had negative $1 million of net income and adjusted EBITDA of $0.5 million. Gross profit in the quarter was $2.5 million versus $0.9 million last year. The full year guidance they gave of $28 to $30 million implies Q4 revenue of $12.4 million at the top end, and they have a backlog of $25.8 million. About half in Q4 will be recognized. A lot of the revenue in the current quarter is still from the legacy business with energy contracts, and only $0.26 million comes from the new data centers, so there's still a big business pivot. But those new data centers just launched recently, so we weren't expecting a whole lot of revenue from them just yet. The company also raised $50 million of capital to capitalize on the data center market and retire some of their old debt. There's a recent partnership with Fiber Light to expand coverage with telecom carrier footprints. Currently, the company has 6 edge mobile data centers, and they landed their first in Illinois recently, with a target of 15 by the end of the year. A couple small concerns I have are the CFO is retiring, and the CEO serves as a dual CEO of APR Energy. That's the company that DUOT has some contracts with to get the energy revenue. It sounds like those energy contracts are winding down as the data center business ramps up, but that is a bit of a complex arrangement. Additionally, the company is targeting reductions in staff from their railcar business. But I think that's a good sign. The company will become more operationally efficient and concentrate more on the data center market. They also announced a new business line with selling infra equipment services, and they're looking to scale that up soon. They've secured manufacturing relationships with different customers, and they said there's going to be an announcement in a couple weeks. One direct quote about the data centers is the data centers are hitting on all cylinders. Overall, this is still a really small company doing a big business pivot, but I'm very enthusiastic about what this business can become. Our next company is Dave Inc. with symbol Dave, and their product is a membership-based alternative bank. The company had previously guided full-year revenue from $505 to $515 million. In this latest report, they raised their guidance to $544 to $547 million. The implied guide for Q3, which they just reported, was $138 million, and they landed at $151 million, which was up 63% year over year. The Q4 implied guidance is for $156 million, which would be up 54% year over year. And that would be a sort of small sequential increase going from 151 to 156. But typically this company's been beating their guidance by a lot recently. On the profitability side, full year adjusted EBITDA was guided for $180 to $190 million. In this latest report, they raised that adjusted EBITDA guide to 215 to 218. Another impressive stat from the report was that adjusted net income came in at 61 million, which was up 193% year over year. On the narrative side of the report, management mentioned the ramping marketing spend through the remainder of the year. The ramping marketing spend is likely to increase top-line growth, but it could impact profitability a little bit. And with the Dave platform, it costs much less to service members versus traditional banks. The company saw extra cash grow 17% quarter over quarter, and ARPU growth was 42% year over year. They also said high-margin subscription revenue grew 57% year over year. One direct quote was, "All aspects of our growth strategy are performing exceptionally well." My big concern for Dave is with their total members. Currently, they have 13.5 million total members, and that's versus 11.6 million last year. So the revenue and profitability metrics are growing much faster than user growth, and that's something to look out for. But overall, we were pretty impressed with this report. And the last 2 quarters have provided strong results, while the stock price has stayed flat, and that could be an opportunity for us. The next company we own is BioHarvest Sciences with symbol BHST. Their product is botanical synthesized compounds. Yeah, I did end up trimming my position some after the strange way that this company pre-announced earnings. They snuck the revenue and profitability numbers into a separate press release that was on a partnership with another company. But I decided to hold the earnings and see what they said there. And actually, I was pretty impressed with how the report sounded. On the numbers side, Q3 revenue was 9.1 million, which was up 36% year over year. But the Q4 guidance is from 9 to 9.5 million of revenue. Normally, we don't like to see that flat sequential revenue, but we do like a lot of aspects of this story as the company is ramping up its production. On the profitability side, Q4 adjusted EBITDA was guided from negative 0.6 million to 0. The company's been mentioning they expect to get profitable on an adjusted EBITDA basis soon. Gross margin in the latest quarter was 61%. Versus 57% a year ago, and the company said the increase is from increased manufacturing scale and yield. The company raised 30.8 million of capital for their expansion plans. One thing I like about this company is how big their vision is, and they talk extensively about the big breakthrough they have in botanical synthesis capabilities. BioHarvest announced a partnership with another company on a saffron-based compound. And they mentioned this partnership deal will have very high margins. Their CDMO business, or contract manufacturing, is expected to grow as well. They said we expect additional partners could onboard in the coming quarter. Later they added, pipeline right now is intense and deal flow is significant. There's early traction in the Health Pros affiliate program, which the company is expanding. And their broad-based release of the electrolyte drink launches on December 3rd. The company says they've configured their marketing stack and e-commerce platform for an aggressive rollout. On the drink product, they said it's an amazing overall sensory performance of the product. One analyst even confirmed that the product tastes great. On the drink product, they said we'll see a ramp up every single quarter. And from our perspective as a growth investor, when there's a consumer product, we'll want to order it and see how it is. So after their drink gets launched on December 3rd, we'll try and order some and see if it really lines up with what management is saying about the great taste there. Our next company is Paymentus with symbol PAY, and their product is SaaS-based payment solutions for enterprises. We previously owned Pay, but we sold after the guidance was not lining up with the enthusiastic story that management was telling. but the management team has consistently been giving conservative guidance. And this quarter was actually a huge overperformance. The company had guided Q3 revenue from 278 to 282 million, and they landed at 311 million. They beat the top end of their guidance by over 10%, and that's pretty unusual to see a SaaS company do this, which is supposed to have really predictable revenue. The Q4 guidance was from 307 to 312 million. And again, the company seems to just want to guide at what the run rate is currently on the current quarter. But we know how conservative this management team is with their guidance, and we expect them to get over 330 million with the actual results they will post in Q4. One more impressive stat was that adjusted EBITDA came in at 36 million, which was up 46% year over year. This company has a sticky product that customers are unlikely to cancel, and they have the typical land and expand model for SaaS. They said on the latest call, "We are going to be a lot larger company." And quoting management on their pipeline and backlog, they said both are actually very strong. They also added on the current quarter, it was a phenomenal quarter of onboarding activities. Another detail was that contribution profit per transaction grew significantly, and the customer mix is shifting towards enterprise and larger mid-market customers. They said there's an early launch of several large enterprise customers. There are some stats that are a bit of a concern and holding me back from increasing this position. Transactions processed was up 17% year over year. Adjusted gross profit was up 23% year over year, and contribution profit was up 16% year over year. So typically we'd like to see all these metrics growing a bit faster, but we are getting pretty fast growth on revenue and adjusted EBITDA, which are the most important. Some interesting takeaways are that the stock price is the same since they IPO'd back in 2021. The company was only doing 100 million of revenue per quarter back in 2021. Although we should keep in mind that 2021 was peak SaaS valuations, but the business has delivered over the last 3 years significantly. Other enterprise SaaS companies get much larger multiples. Our theory here is that the market probably lumps them together with the kiosk payment systems or the lower quality payment solutions. But this company is selling to enterprises and does have a real SaaS model. The next company we own is a new one called SkyWater Technologies with symbol SKYT. They are a US-based semiconductor fab. We did a detailed write-up of this company over on Salesboard, and there's a link in the video description. Shout out to the folks coming over from Salesboard. This company has a technology as a service model for quantum computing and other industries. And the management team detailed they onboarded 4 quantum computing customers in the latest quarter, and that makes the total of quantum customers to be 7. So that's really great to see they more than doubled the number of quantum customers in this quarter alone. And I'm actually pretty surprised to hear that quantum revenue is actually selling. So we've been hearing for so many years about the potential for quantum computing, and now it actually starts to be ramping up here. The company has a recent acquisition of a company called Infineon for about $350 million, while the market cap of SkyWater is just $750 million. So it's sort of more similar to two businesses merging together. Revenue in the latest quarter was 151 million, which is up 61% year over year, but this includes the acquisition. The next quarter guidance is from 155 to 165 million, and it seems conservative, but it's hard to know. It's somewhat challenging to figure out the organic growth of both of these businesses together. But the company did say on their latest earnings that they exceeded our expectations across all metrics. There was stronger than expected profitability on gross and operating levels. And they mentioned that quantum computing continues to be the fastest growing segment. So a lot of our thesis here is that this quantum computing segment can outperform and drive results. There's more fab work than expected, and they said this allows us to run hot as we enter 2026. SkyWater is the only US-based pure-play fab for this type of work. Some takeaways from my perspective are that quantum computing stocks have a huge amount of hype and valuations right now. And it's possible that SkyWater gets scooped up in the hype cycle for quantum or becomes a meme stock. Our next company is FIGR Technologies with symbol FIGR. They're a new company that we're really excited about, and they do blockchain lending, trading, and they're an investment platform. The company just went public in September of 2025, and they had their first earnings on November 14th. The platform tokenizes loans, home equity lines of credit, consumer credit, and mortgages. They're expanding to an SEC-approved stock exchange that runs parallel to NASDAQ. And normally ideas like these are commonplace in crypto, but the projects end up going nowhere. The difference with this company is they already have strong results and very big growth on the platform. Revenue in the last quarter was $156 million, which was up 55% year over year. And net income was $90 million, which was up 227% year over year. So the company is already posting huge growth on the top and the bottom line. Additionally, ecosystem volume grew 38% year over year, while the consumer loan marketplace grew 70% year over year. The blockchain solutions save 85 basis points of securitization costs, and it reduces third-party review costs as well. While 85 basis points might not sound like a lot, there's pretty thin margins on securitizing these types of loans, so that probably helps a lot. Currently, the company has 250 partners on their platform. Loans are originated end-to-end without human involvement. There is also data transparency, which the customers like a lot. Origination partners include banks, credit unions, and mortgage companies. This quarter onboarded one of the largest mortgage servicers in the US to the marketplace. The company also added 7 new buyers to its securitization program, including a prominent sovereign wealth fund. One analyst said, "You obviously crushed all our expectations." And normally when a company does well, you might see an analyst say, "Congratulations," or "You really impressed us." But that statement from the analyst is really over the top when they say, "You obviously crushed." So that's a really good sign for investors that this company is way outperforming what the analyst thought. And if you're interested in this company, there's a special call on November 18th, which detailed the new tokenized stock market. This was a really interesting read-through. Their new stock market has 4 key advantages. It offers faster bilateral settlement, 24/7 trading, cross-collateralization of the security to other assets, and the ability to lend or borrow the stock transparently. Our next step in our research process is to go deeper in the S1 IPO document and see what additional details we can find there to hopefully increase our confidence in this company. One new low-confidence company we own is Evaxion with symbol EVAX. Their product is an AI-powered platform for discovering vaccines and therapeutics. They're a tiny Danish company with a $50 million market cap, but they're listed on the NASDAQ as an ADR, so it's fairly easy to buy. Recently, the company unlocked a cash payment of $7.5 million from Merck on a milestone payment. Potential milestone payments with Merck go up to $592 million, plus the potential for royalties. While it's unlikely they would unlock all of that, it's still a really good sign there's a lot of potential upside here. They said their platform is the first ever in licensing of an AI-discovered vaccine candidate by a major pharma. They also added their AI platform automatically performs the complete process of target discovery and vaccine design. The tooling can be applied to new and existing vaccines. Additionally, the AI platform has been enhanced with new automated vaccine design modules. This idea sounds really promising to me, along with the company unlocking significant milestones. The operating expenses for this company should remain low because the platform is discovering rather than needing to hire researchers. This is still a small and high-risk company, but we'll be continuing to investigate and learn more. Lastly, on the price of the stock, but then it's come down to a much more reasonable level and trades around $6 right now. The Merck milestone payment saw the stock shoot up to $12 a share. The last low confidence position we own is Organigram with symbol OGI. They are a cannabis producer that's based out of Canada. And our strategy here is we're waiting for the earnings report in December. The company recently hired a new CEO who worked in tobacco for over 20 years. A new CEO can be a double-edged sword. Sometimes they can bring new ideas, leadership, and enthusiasm to the business. But other times they have less experience, less company know-how, and they may face company-specific challenges or a potential culture clash. When we look back at the last quarter for Organogram, they lost some expected revenue from a software mishap on an ERP system. But the issue was resolved last quarter, and this presents potential upside to the current quarter now that they have that resolved. The industry for cannabis is seeing positive regulatory momentum, and we'll be looking to reevaluate this company on the next earnings report to see if we want to hold here. Taking a look at companies we sold this month, the first was Health and Tech with symbol HIT. They were a medium confidence position, and their product is a B2B health insurance platform. Revenue landed at $8.5 million in the latest quarter, after the previous quarter was $9.3 million. And we knew this company has some seasonality in their revenue trends, but we thought the company had overcome their seasonality and would get closer to $11 million in revenue. We thought this because of how strong the last two transcripts had read. The company gave Q4 guidance in a weird sort of way where they said projected Q4 revenue is expected to be up 50% from last year. Normally for a growth company, growing 50% year over year is really good. But in this case, the previous Q4 revenue was only $4.9 million. And a 50% increase from $4.9 million is just $7.35 million of revenue. So that would mean we have two sequential declines in revenue in a row. The company did mention they're anticipating sales volume shifts from Q4 to Q1. And my take was that management probably doesn't want to discuss the truth of the issue here. And that's that the uncertain regulatory environment is hurting their business. But I do want to check in next quarter when they report and see what they guide Q1 for. We could end up getting back into this company if Q1 is guided really strong and it turns out all those sales really did shift to Q1. A couple other question marks surrounding this business came up on their last report. They mentioned they'll be going to Davos and presenting at a conference there, looking to attract new investors. I'm not really sure on that strategy. Davos is known for European elites, and they're going to demonstrate a US insurance product there. I also wasn't sure on their strategy with blockchain. I did not find the blockchain explanation convincing. I was wondering why they're not just using a standard database in View, because these are not immutable records. They'd be storing health insurance claims on the blockchain, but sometimes health insurance claims need updates if there's mistakes or edits. And I would have liked to really see them explain blockchain to explain how it's going to increase revenues or get better margins. One big takeaway is the hardest thing to do as an investor is admit when we were wrong. We were really starting to build a lot of confidence in this company after their last two reports. But the numbers and the guidance simply came in a lot worse than we were expecting. So it's important for us to reevaluate and change our mind. But like we mentioned, we'll check in again on this company on their next earnings and see where their guidance lands. Maybe they're getting back on track. Another company we sold in the month was Applied Optoelectronics with symbol AAOI. Their product is optical hardware solutions for data centers and cable TV plus streaming. They had guided revenue from 115 to 127 million and landed at 119 million. So the revenue landed within the guidance range, but towards the lower end. And typically we want to see our growth companies beating their guidance. Adjusted net income was guided from negative 5.9 million to negative 2 million, and it actually landed at negative 5.4 million. So again, the profitability metrics landed on the lower side of the guidance and did not beat the guidance. The next quarter revenue guidance was for 125 to 140 million, with adjusted net income from negative 9 million to negative 2.8 million. Normally, when we get a step up in revenue, we also want to see profitability increasing. But here the company's getting more revenue and they're expecting to lose more money with that. Part of the reason is they have increased capex for factory capacity expansion, and that may continue for a while, drawing on their profitability. The company looked to be trending towards profitability previously, so we were a bit disappointed on this adjusted net income guidance. One other concerning detail from the report was data center revenue this quarter was up 7% year over year and down 2% quarter over quarter. But their CATV segment grew 3 times year over year and went up 26% quarter over quarter to contribute 70.6 million of revenue in the quarter. Yet the next quarter guidance for CATV is guided from only 50 to 55 million, which would be a sequential decline in the CATV segment. However, data center revenue is expected to be a big boost, and that's how the company is able to guide up their overall revenue for next quarter. And the company did mention that this quarter had a missing 6.6 million of revenue from a shipping delay. But business momentum seems up and down here. CATV was up huge this quarter, but then down the next. And then data center revenue was weak this quarter, but guided up strongly for the next quarter. So we'd like to see a bit more consistency. A lot of our companies which are selling AI hardware are seeing strong sequential increases in revenue. This company also has large customer concentration issues, and that can potentially be a problem if a customer completes a project and then drops off in the next quarter, which seems to be happening with this business. Overall, this company still sounds promising, but we're just not excited enough about the business, and the numbers were a bit of a disappointment. Another company we sold this month was Niagen Bioscience with symbol NAGE. Their product is a supplement for anti-aging that has other health benefits. Revenue landed at 34 million, which was up 33% year over year. That's with record net income of 4.6 million. Those results seem pretty good, and the full year guidance was raised a bit. However, if we backed out the numbers, which was a bit tricky, it implies 33 million of revenue in the next quarter. That would be sequentially flat, And the big issue is the comparison versus last year is 29 million in Q4, and that would be only 17% year-over-year growth. That's definitely a bit lower than we're looking for to find a growth stock. I put a question, could they be sandbagging here? A lot of management teams will underestimate how much they can get, so they can always beat their guidance. But we don't have enough confidence here that they're definitely sandbagging. We've only followed this company for 1 quarter so far. So we're not going to stick around to find out whether they're sandbagging or not. On the positive side, they did say they have continued e-commerce momentum and new B2B business partnerships. They also successfully challenged another company on NAD plus claims. NAD is a precursor to Niagen, but it's not as effective, and the company's been going after companies which are less regulated. Overall, the growth is just not as big as we expected, but it's worth checking in next quarter to see how the guidance lands. One company we sold this month is called Nephros, with symbol NEPH. Their product is water filters that are sold to industrial and commercial businesses. Revenue came in at 4.8 million, which was up 35% year over year, with net income of 0.3 million. However, I was looking for this company to get over 5.3 million. And if you watch some of the strategy videos we do, we like to have a revenue number in mind that we'd be happy with. This gives us an objective barometer to see how the company performed. Even though there was 35% revenue growth year over year, there is an issue if we look back at the previous quarters or longer back. The prior quarter was 4.4 million of revenue, and the one prior to that was 4.9 million. So this 4.8 million is not record revenue. If we go back and look at Q1 of 2023, the company was getting 3.7 million of revenue, and that shows this business is not ramping too fast. So now we've got about 3 quarters in a row of mostly flat revenue. And there could be some seasonality in this business, but we're not too sure on that part. The company did say they have the highest level of programmatic business yet. And their PFAS filter, which treats forever chemicals, was launched in October. Regulations by the government for how these filters should work are still under development. And the company believes they have the best product in the market or the most superior. They say when the regulations land, it should benefit them. That way they can prove they have the superior product, and it may give them additional business momentum. But in the end, we may have read too much into the growth story here. So we decided to sell and reallocate that money elsewhere. The last company we sold was ZOMD Technologies, with symbol ZOMD.V. Their product is a marketing and acquisition platform. Revenue landed way lower than we expected at 16.1 million, which was actually down 3% year over year. And the previous 2 quarters had revenue of 18.2 million, followed by 19.6 million. We had this company in the microcap ventures category, meaning we were waiting for the report to decide our next action. One key takeaway or lesson is that our numbers and narrative approach requires we have compelling numbers. And the strong sequential decrease in revenue makes this company uninvestable from our perspective. We sold our shares after reading the press release and seeing the numbers. And we were left wondering if this is really a SaaS company with recurring revenue, or maybe a big customer dropped off in the quarter. Something's just not adding up here, because normally SaaS companies see their revenue increase quarter over quarter, even if the growth rate is slowing down. One question that may come up is why not read the report and get some lessons learned from the company? One key takeaway is that our time is really valuable, and that hours spent reading the report could be spent elsewhere. There's more value to researching a new company or learning more about one of our existing companies. Now let's take a look at some promising new ideas. And these are ideas that seem promising, but where we ultimately passed on investing. The first stock is Exzeo Group with symbol XZO. They are a recent spin-off IPO from a larger insurance company, and they do insurance as a service, operations, admin, and quoting. The financial data for this company is limited as they haven't reported their first quarterly earnings as a public company yet. And in their S1 prospectus, they gave financial data for the last 6 months, which isn't really standard, but it's what we have to work with. The last 6 months had 109 million of revenue, which was up 80% year over year. And the cost of revenue only went up 25% year over year. So it's nice to see those two metrics together. Additionally, net income was 40 million for the last 6 months versus 9 million a year ago. The company's managed premiums and policies are up over 100% year over year. But most of their customers implementing their SaaS solution are based out of Florida. And they're effectively referrals from the parent company that spun off this company. My understanding is the Exzeo platform allows insurance companies to set up some of the trickier parts of the tech stack. And so there's a big value add to starting on the Exzeo platform for a lot of these insurance companies. But ultimately, I ended up deciding to pass on this company. I want to see how their first earnings report goes as a public company since we have pretty limited financial data right now. Additionally, I'd like to see the company's customer base expand out of Florida a bit more and also expand from just getting referrals from the parent company. The next company we took a look at is called Organogenesis with symbol ORGO. The product is advanced wound care skin substitutes. Revenue in the latest quarter was 151 million, which is up 31% year over year. They had EBITDA of 27 million, net income of 22 million, and a market cap of just 710 million. What's got me interested in this stock is they had guided revenue from 130 to 145 million, but the actual that they landed at was 151 million. And the full year guide is a pretty big step up as well. It implies 186 million for Q4 at the top end, which would be up 46% year over year. However, the market that Organogenesis sells to is in a bit of turmoil. It seems like there may have been some reimbursement fraud or mispriced products, and the government is the one who's reimbursing a lot of these sales. The newer regulations actually hurt lower regulated companies more, such as BioStem, a company we used to own and who's a competitor here. So I'm thinking to stay on the sidelines for a bit and see how this competitive situation develops. I do think Organogenesis is winning in the marketplace versus BioStem and other competitors. But I'd like to see the regulations stabilize a bit here, which would help me gain confidence this company can continue to be successful. The next company we looked at is called Telos Corporation with symbol TLS. They're a SaaS security solution for cloud, identity, and messaging. Revenue in the latest quarter was 51 million, which was up 116% year over year. And they had negative 2 million of EBITDA and negative 2 million of net income. So the company is not profitable yet on a GAAP basis, but the market cap for this company is only 430 million. They did mention on the conference call that forecasting existing programs for next year will generate at least 180 million of revenue in 2026. But when you divide 180 million by 4 for the quarterly number, It's only 45 million per quarter. And for this company to continue to grow, management is telling us they need their new products to land. And it did sound from the transcript that the new products are probably going to do well. There seems to be good early feedback from customers. But I'd really like to see management themselves have more confidence than guiding for below the run rate on their existing products and not telling us how much the new product may generate in revenue. The management team also mentioned there's a disruption from the government shutdown. And while the shutdown has completed, it may disrupt the next quarter's business. They did mention they have a multi-billion-dollar pipeline, though. But I'm not confident all that pipeline will turn into revenue in the near term. Taking a look at more promising new ideas. Another stock we looked at is called Daily Journal Corporation with symbol DJCO. Their primary business used to be newspapers and websites. However, this almost hidden SaaS business exists within the company, which makes up 79% of revenues now. The SaaS business is showing impressive revenue growth, having generated 18.5 million of revenue in the latest quarter versus 13 million a year ago. The software is sold to government agencies and the court systems. It seems like some sort of all-in-one package for courts or the justice system. What makes this company so unusual and so unique is they actually have 443 million of stocks. Their stock portfolio used to be run by Charlie Munger, Warren Buffett's business partner. In previous quarters and years, this company was earning maybe 1 to 2 million of net income. And so I was kind of curious how they got up to over $400 million worth of stocks. And I think the answer is just compounding and investing well. Ironically, this is one of the most unfriendly companies to investors I've seen in a while. They do no earnings calls, no presentations, and they only do the required filings. They almost seem to be anti-marketing themselves to investors for some reason. But with a market cap of just 617 million, this makes the SaaS portion of their business fairly priced. I am holding off on investing here because the story's pretty complex with all the stocks they own, and we don't know which companies they own either. But it may be worth keeping an eye on the SaaS portion of the business and to see if that keeps ramping up. The next company we looked at is called Vusion Group. Their symbol is VU.PA, indicating they trade on the Paris Exchange in France. They make IoT devices for cloud and data analytics. Revenue in the latest quarter was 362 million, up an impressive 50% year over year. They had EBITDA of 30 million, net income of negative 5 million, and that's with a market cap of 4 billion. The gross margins are on the lower side at 28%. And the company is struggling to cross into the threshold of profitability on a GAAP basis. There's no dual listing or ADR for this company, and we would need to buy it on the foreign exchange. In the end, there wasn't enough to get excited about here, but this could be an interesting company to watch. One more company we looked at this month is called Adaptive Biotechnologies with symbol ADPT. They have genetic and clinical diagnostic solutions. And the company is seeing growth in testing volumes and achieving regulatory milestone payments. They had a huge step up in revenue last quarter, coming in at 94 million, which was up 102% year over year. Additionally, the company got 15 million of EBITDA and 10 million of net income. So this company is already profitable. But I really want to confirm this quarter is not a fluke, and I'm cautious about the sudden jump up in revenue. Sometimes these biotech companies can achieve milestone payments, making it look like there's a big acceleration in the business. But the revenue can be lumpy, and I wouldn't be surprised to see a sequential decline in revenue next quarter. But we'll keep an eye on this one in the meantime. Next, let's look at revisiting some promising new ideas on some companies we used to own. And these companies have recently reported strong results, which warrants another look at them. The first company is GeneDx with symbol WGS. They're a former medium confidence position that does genetic testing panels. Revenue was $117 million in the latest quarter, which was up 52% year over year. But net income swung to a negative again at negative $8 million, even though the last quarter was GAAP profitable. The company did raise their full year guidance, but the Q4 implied guide is $121 million, a small step up from the $117 million in the current quarter. The company did mention there may be upside from California, as the program called Medi-Cal is coming online for their tests. I'm not sure how much additional revenue that Medi-Cal may bring in, but I would have liked to see the guidance be a bit higher if they're anticipating more revenue from that. I'm still a bit spooked by the previous revenue drop-off earlier in the year, which was blamed on climate change. The CEO blamed the LA wildfires and the northeastern cold for the poor revenue results on Q1 of 2025. And that explanation made zero sense to me. So I am a bit concerned we could have revenue drop off randomly one quarter without a decent explanation. GeneDx has a valuation of $5 billion, so the market already is pricing in a fair amount of upcoming growth. I would really like this opportunity a lot if the market cap was still around $2 billion, but we'll want to keep our eye on this company coming up. The next company we looked at was Amprius Technologies with symbol AMPX, and they're a former low confidence position that makes solid state batteries. Revenue in the latest quarter was $21.4 million, which is up 173% year over year. And they're finally getting to gross margin positive, but they had negative $3.9 million of net income in the last quarter. One new development since the last time we looked at this company is they have on-demand manufacturing now. So it seems like they resolved some production issues they had before. They mentioned on their call that 75% of their revenue comes from outside of the US. That was somewhat surprising because I don't remember it being that high before, and I thought they were selling to mostly US customers before. It seems like electric aerospace is picking up big time. And they added they have only one customer that makes up over 10% of revenue. That's pretty encouraging that their revenue stream is diversified. In the latest quarter, they shipped to 159 end customers, 80 of which were new, and 79 repeats. They did clarify in the question and answer session that customers often come and go. So they might have a customer who orders some batteries in Q1, but then they skip all their orders in Q2, and then reorder in Q3. And this is why you might see 80 new customers in one quarter. But these customer numbers are still a big step up from what they usually report, and the analysts congratulated them on how many new customers they're getting. Ultimately, we're still on the fence about this company. The market's already keen to the opportunity, as the market cap is $1.5 billion. When we sold this company the last time, I think the market cap was around $250 million. But back then, they were experiencing a lot of production issues and a lot of increased capex, along with dilution or debt raises. The last company we looked at was Celestica with symbol CLS. They are a former watchlist company that is a computer hardware builder for hyperscalers, and they benefit from the AI trend. Total revenue was $3.2 billion, which was up 28% year over year, with EBITDA of $370 million, net income of $268 million. but their gross margin is pretty low at 13%. And normally when we see 28% revenue growth, it doesn't interest us that much. But the company does have a legacy business that's holding them back, and that's mostly flat. However, their data center business now makes up 76% of revenue and is growing 43% year over year. That 43% growth on their data center business makes this worth investigating. One new development is I was surprised to see the company is doing more ASIC-based work for hyperscalers or building custom chips. But I'm also on the fence about this one for valuation reasons. The market cap got up to $40 billion recently, and there's been no sell-off in the price while other AI companies have sold off more. Let's conclude with some final thoughts on the month and our growth stock portfolio. It was a tough month for results. There's no sugarcoating it. But we use mental game strategies to help dissipate the fear. And we have a number of videos on investor psychology on the channel if you want to check those out. We spent a good amount of time this month adjusting our portfolio after the earnings results. And we're continuing to find new promising companies. There's a few upcoming strategy videos for the channel, so definitely subscribe with the notification bell, and it helps the channel to like this video as well. The first video we have is going to be on growth investing psychology, and we just mentioned we've done some videos on this topic before, but there's still a lot of newer aspects we want to cover on this topic to make the approach more comprehensive. Additionally, we have a pretty fun video coming up where we review a book called Common Stocks and Uncommon Profits. The author is Philip Fisher, and this is one of the books we have in our study corpus for growth investing mastery. This book is from the 1950s, but it's crazy how accurate the advice still is in 2025. This concludes the video. As a last reminder, this is not investment advice or recommendations to buy stocks. Thank you for listening.